So welcome to the online version of the Milton Buyer Class. My name is Chuck Charlton with the Charlton Advantage team here in Milton. Now, this information is applicable not only if you're looking to buy in Milton, but physically this is where we run the class in Milton. We've been running it for about 10 years now. We've had well over 1,000 people come to the class, and this is our attempt at trying to give you the information online, a bit of a different thing for 2020. So we're filming this in spring of 2020. There is information that will change over time. There's some information even since we've started the class that's changed as well. Now, the first question I always like to ask people when they join the room is, what do you want to learn today? And another way of asking that is, what is keeping you up at night about this process of buying a home? I mean, it's very intimidating. And the example I sometimes use is, if you're at the top of a ski hill and you know how to ski, you're really excited about that. But if you don't know how to ski, it's just you've never had lessons. It can be very, very intimidating. And that's a lot like buying a home. For someone who's uninitiated by the process, it's very overwhelming. So let's get started with some of the stuff we normally talk about. And you are displaying some courage right now by watching this video. It's not a short video. I hope to be done by the time it takes to watch a movie, but there's a lot of information here. And this quote comes from a man named Walt Disney, and it said, "All our dreams can come true if we have the courage to pursue them." And even purchasing a home and going through the home buying process, it takes some courage, and it takes a bit of discomfort, and you have to be okay with that. Just like anything in life, you want to kind of stretch yourself a little bit in order to grow. Now, the reason we started the class is because we saw faces like this and like this, a little bit of confusion, a little bit of frustration, mostly because people are paying their landlord's mortgage and making the landlord rich, and they're tired of it. And a little bit of frustration, particularly when they're looking at this site, which is the biggest real estate site in Canada. It's a great place to gather information. When you really get serious about buying a home, I'll tell you there's some other options. That'll be later in the video in part 2. So then you look at the news and you see all these things happening. The bubble has been waiting to burst for 12 years now, or 20 years. And you'll talk to friends and your parents, and they'll say it's a good time, it's not a good time, who knows? And so it's really hard to say, who do you believe? The problem is that the rear view mirror is always clearer than the windshield. And I know a lot of people that wish they had got in the real estate market 10 years ago and didn't. I have a feeling that's always going to be true. One of the guiding principles was something said to me years ago, and someone said 25 years later, nobody ever regrets buying real estate. And I found that to be absolutely 100% true. But this class is not here to convince you about whether it's the right time for you or not. It's really about saying, here's the information. Do you think it makes sense, or doesn't it? And whatever you choose is okay. And if you choose to work with us, we'd be delighted to help you any way we can. If you choose to work with somebody else, that's okay too. We give information. Our values on the Charlton Advantage team is to give information, lead with the giving hand, and then whatever happens after that, we're probably going to be just fine. So there's a lot of sources of information out there, and eventually you get a little confused, and then most people just say, hey, forget about it. I'm done. I'll worry about this next year. I'll rent for another year. And that may or may not be the right thing for you. So part 1 of this class, I'm going to split these videos up a little bit. Part 1 is where we talk about affordability. I would say the overriding theme of part 1 is your money. Is it better to rent or buy? What are typical closing costs? What government programs do I qualify for? There's some really exciting information there, and some links we can share with you too. 4 reasons getting pre-approved benefits you. Do I qualify to receive free government money? And a lot of it as well. Can I see my credit report? Is my credit good enough? Mortgages, what are the 4 things that lenders look for? And how can I avoid getting stuck with a bad mortgage? Also, is it possible to buy a home with 0 down payment? Then in part 2, we're going to talk about the 8 steps you should take to buy a house. We're going to talk about how to guarantee your agent's going to protect you. How can you get the best access to listings, sometimes even before they hit the MLS system? How can I avoid overpaying for a home? How do I really know what a home is worth? What are the differences between new and resale homes? Home inspections, do I need one? And then we start looking down the line towards things like the lawyer's role in the process. And that's our team. As of 2020, that's the amazing group of people that we have. And the Charlton Advantage team is here to create 5-star real estate experiences that people love talking about. So I really and truly hope that this buyer class online is a 5-star experience for you. And if you want to see what kind of experiences people have working with us, I'd encourage you to go onto Facebook or Google and look at the reviews and just see what people have to say about us. When we're done with this class, while you're watching this online, by the way, I would encourage you maybe to grab a pad to make some notes. And I can also send you the workbook that we use and we give to clients once they come to the class. It's going to feel like you're drinking from a fire hydrant. If you've ever tried that, the water's coming out fast and furious. And all I want you to know is you are not alone after this class is over. You're always free to reach out to any of us on the team, including myself, and we want to be your real estate resource. So by the time the class is done, you're going to feel nice and light. You're going to feel relaxed, confident, and of course, protected. You knew I had to have Bruce Lee in those slides. This is actually something I haven't updated in a while, but we've had over 1,000 people graduate from the class. We're well over 1,600 pounds of food that we've collected over the years and given that to the Salvation Army Food Bank. That's the number of people, 375,000 people in Ontario that use the food bank on a regular basis, out of a population of about 13 million in Ontario. 1,000 plus in Milton. In a community like ours, there's about 1% of the population that is a regular user of the food bank, and 40% of those are kids. So it really does make a difference. And usually before we get started, I talk about where the bathrooms are and everything else. But let's get to the real topic in the first part of the class, which is your money. Now, money is a funny thing because, of course, you need money to buy a home, but you also have other dreams too. And so maybe you want to see your kids graduate and have a great career, get married. Maybe you want a cottage. Maybe that's a legitimate dream. You want to play some golf. A lot of times people who are buying their first home, they just want enough they can go out to dinner once in a while, hang out with their friends. And so whatever it is, your house has to fit into your big picture. If the house overtakes the big picture, if every payment uses up all your money, that doesn't make any sense. So whether or not the bank will approve you for a certain amount doesn't take away your personal responsibility and your own financial planning to say, how much should I allocate towards the house? So the two things we look at for money as far as, what you're going to need is you're going to need something down and you're going to need something per month. Okay. So the initial down payment, you see it all the time in other industries. You see it with cell phones, get the new iPhone for $99 and pay us, $79 a month. You see it with cars. So you can lease, a Chevy Equinox up in the top middle for $147 a month, and it says it's a 24-month lease. There's $999 down and no security deposit of any kind. So if you did the math on that, you could figure out all the different value and interest rate and all the rest. But that's kind of how it works with real estate too, is there's an initial upfront cost. And so we compare it sometimes in the class, renting for $2,000 a month and buying for $500,000. So your upfront cost for rent would be first and last month. In Ontario, that's all that's required. There are tenants that voluntarily offer more, but it is not a requirement from the Residential Tenancies Act. Security deposits are actually illegal in Ontario. You can ask for a key deposit, but only for reasonable cost of replacing the key. And so for buying, your down payment could be anywhere from, $0 to $500,000. In Canada right now, consider 5% to be a minimum down payment for any property you're going to purchase. So a $500,000 property, you're going to need $25,000. And there's a difference when you hit 20% where your mortgage insurance is not going to be required. So if the bank is going to finance anywhere from 80 to 95% of the value of the house through a mortgage, they're going to ask that you insurance. And we'll talk about that a little bit later. So you're the one who has to insure the bank in case you don't pay. Okay, above 20% down, there's no mortgage insurance required through the Canadian Mortgage and Housing Corporation, which you'll hear us refer to as CMHC. Legal costs, roughly, $1,500, $1,600. Probably half of that is the lawyer's fee for their time. The other things are disbursements. There's a registration through the province of Ontario, title insurance. Some of those extra costs are going to just be downloaded to you at no additional cost. So that's roughly what you're going to spend on a lawyer. For a $500,000 purchase, you're going to have something called an Ontario land transfer tax. In this case, it's $6,500. It's a scaling number, so it goes, I think it's the first $50,000 or $60,000. There's a certain 0.5% from whatever it is, 60 to 250,000. Whatever it is, there's a scaled amount. It goes to 1%, 1.5%, 2%, and so on. So for this amount, $6,500 approximately. If you're buying in the city of Toronto, which we would call the 416 area code, you would have an additional Toronto land transfer tax, which would be about double the total. So if it's $6,500 to buy a property with Ontario land transfer tax, it would be about $13,000, about double the $6,500 to do it in Toronto with both taxes. So there it is there. There is a rebate. So up to $4,000 is rebated back if you're a first-time buyer. And that's for both taxes too. So all of a sudden you'd save $8,000 when purchasing in Toronto, and you'd save $4,000 if you're buying in somewhere like Milton. So the next one is there's an 8% provincial sales tax. Most of us only thought HST exists, but there is PST on certain things. That's an 8% tax, and it's on the insurance premium if you're putting less than 20% down. That's considered a closing cost. You can roll the insurance premium into your mortgage, which we're going to show you later, but that tax cannot be rolled in. You got to pay it up front. So a good rule of thumb for closing costs is it's about 1% to 1.5% for first-time buyers, and it's about 1.5% to 2% for people who already own a house. The major reason for that is the land transfer tax rebate for first-time buyers. That's why those differences exist. So if you had a condo, you're moving to a detached home, you purchased the detached home for $800,000, then I would say keep about $16,000 set aside. I would do a little bit more math just to back that up. And that would include the lawyer, and it would also include the Ontario land transfer tax. There's lots of places online you can find Ontario land transfer tax calculators. I have a great app on my phone that I like to use, and it's called the Canadian Mortgage app, and I've loved that one for many years. Now, remember too, when we talk about upfront money, your furniture, okay, so there's a study done by Genworth that said that something like 18% of first-time buyers go into debt after they purchase because they bought furniture. Now, you don't want to be putting that stuff on a credit card, so make sure you can float that up front. And I believe an additional 18 or 20% of people went into debt for unforeseen expenses. So whether that meant their car broke down, when they moved into the home, there were problems, even though they did an inspection, maybe the fridge broke down. The point is save a little bit of a cash cushion. That's always a responsible thing to do in your life. And the last note I'd say is new homes are going to have additional closing costs. So there's a warranty on a new home through something called Tarion. Guess who pays for that? That's you. Utility hookups, the builder's going to charge you for those. There's levies through the municipality. So you could be having thousands and thousands of dollars downloaded to you for levies and development fees and all the rest of it. HST applies to new construction. It does not apply to resale homes that already exist. So you want to check and see if HST applies. If the price that's been quoted to you from the builder includes HST or not. There's also a thing with builders where you would sign off and say the builder gets the HST rebate, and then we pay this price. The net amount to you is the price you sign off. Then you look at things like air conditioning. You look at window coverings, fencing, appliances. So we've had many clients that have come to us and said, oh, there's a great deal from this builder. It's cheaper than I can buy resale. And I say, yeah, but they're not doing this. They're not doing that. Have you thought about this and this and this? And before you know it, there's $15,000 or $20,000 of extra costs that they didn't really have any ideas about, upgrades from the builder that would need to be paid. And all of a sudden, it's not looking like a fabulous deal anymore. So that's your upfront cost. So roughly, you're looking at if you're purchasing a $500,000 home, you're going to need your initial 5%. And you could put as much as you want above that. Above 20% will save you a bit of a mortgage insurance premium. And then you've got your closing costs of anywhere between 1% and 2%, depending on what category you fit into and the cost you have. And then with builders, you'd probably add on another, I would say easily 1% to 3% in extra closing costs above and beyond what you'd have with a resale. Okay, so I know that's a little chunky, but it's one of the things that's most misunderstood by buyers. So where would you get the upfront money from? So there's really 4 places. You can get a gift. Now, most lenders require now that you get a letter. So if the bank of mom and dad, which by the way, 1/3 of all transactions now are being helped by family members. So you'd need a letter from mom and dad saying, yep, we're good to give you whatever it is. It can come from your savings. It can come from your RSPs or other investments that you cash out. If it's stocks or, whatever, sale of business, those are typically the 4 ways that people get money. Now, we'll talk about the RSP program specific for first-time buyers. There's a lot of fun things you can do when you're a first-time buyer, or if you haven't owned a home in the last 5 years, and we'll get to that in a little bit. So now let's go look at the ongoing costs, okay? So let's use the same example here. Your ongoing cost is going to be rent. So in addition, after that first month, you're going to have month 2 is you're going to have to start paying $2,000 a month. You're going to have utilities on top of that, contents insurance. So remember, you're not the owner of the building, but you still have to insure your contents. And there's also something called tenant liability insurance that's a good idea to get. Now, buying, let's say it's a $500,000 purchase. You're putting 5% down. You can have your insurance premium. We'll go over all these numbers later. But your mortgage payments are going to be roughly $2,000 to $2,500 with a 5% down payment on this. So a good rule of thumb for today's mortgages, which are hovering anywhere between about maybe 2.5% to maybe 3.5%, would be $500 for every, so a $500 payment every month for every $100,000 of mortgage. So, you get a $500,000 mortgage, that's roughly $2,500 a month. And you can work backwards too. So every $10,000 jump in your budget, it's going to cost you $50 a month. So I hope that makes sense. If you have any questions, there's tons of online calculators, or you can just email us and say, what would the payments be on something like this? Your utilities, you're going to pay for those just like you would if you're renting. Now you're going to insure the building and the contents, so it's going to be a little bit more money there. Your property taxes, so how much are those? In Milton, you've got some of the most competitive property taxes in the GTA. Actually, all of Halton is pretty good. The city of Toronto is pretty good. You get into Mississauga and Brampton, it's a little more expensive. You get into Hamilton, Oshawa, some of the Durham region properties, very expensive taxes, in some cases double what you'd pay in Milton. So you want to look at that as a monthly cost. Some people would move further out to get to Hamilton, thinking they're going to save money on a mortgage, but all of a sudden the property tax bill comes in and they realize they're not saving that much. They have a longer commute, more wear and tear on the car, more gas, and so on, so on. So we always recommend putting about 1% per year for ongoing maintenance of the property. Now, in the first 5 or 10 years, probably not that much, but when you get to 15 to 20 years, your roof, your furnace, your air conditioning, those are all things that typically last 15 to 20 years. Windows now are probably lasting closer to 25 years, although not always. So there, you could have $15,000 or $20,000 worth of repairs that happen somewhere around year 15. It's also a good reason for buying a home that's maybe 21 or 22 years old, because a lot of times that home has a new set of everything. And I would argue they probably built homes better 20 years ago than they did now. But every builder's different, every situation's different. What's interesting to me is someone who qualifies at a 3% interest rate for a $500,000 mortgage, their payment's going to be $22.72 a month. Now, if all of a sudden rates shifted to 5%, now that same $22.90, let's say, if you look in the first column, 3 down, they would only qualify for $400,000. So the big message I like to show with this slide is when rates move from 3 to 5%, so it's a 40% difference in rates, you're actually seeing that your max affordability goes down by 20%. So that's a big deal. Small changes in interest rates can mean massive differences to your budget and how much you can spend. And people ask us all the time, why are house prices so high? And usually the answer is, well, interest rates are pretty low. So now the question becomes, so if you look at how much ongoing, so you know the ongoing is going to be more with property taxes and ongoing maintenance and more insurance, why would you buy a house? You've got more upfront costs, more ongoing costs. Why would you do it? Now, from doing these classes for the last probably 10 years, what we've heard people say is things like just something as simple as, I'll have pride in my house, is that it's mine. A lot of people will say it's a great investment, so it's a forced savings plan. So part of your mortgage payment is going to go towards interest, but another part of it is going to go towards principal, which is money back in your pocket, which is where you're building equity. Some people like the idea that they can buy a home and they can improve it. So they can actually build equity through either smart efforts, so spending $5,000 and maybe having the property be worth $10,000 more. That's really enticing for some people, but you just want to get clear about why you'd want to buy a home. I'll tell you, short term, renting is going to win. It's going to be cheaper. There's less ties to the commitment. But if you're ready to kind of plant some roots, settle down, and really look more long-term towards that 10, 20, 25-year plan, owning a home makes a lot of sense. And it will always make a lot of sense. So this is a funny thing. I've told this to a lot of people who work in the mortgage industry, and they get a kick out of it. So mortgage is made up of 2 root words. The first one is mort, and that's a Latin word, and it means death. And so gage is a Greek word, and what it means is it's a binding pledge. So that word quite literally means binding pledge until death. Now that doesn't sound very good. So how do we get you? Now we get you a home. How do we get you out of the mortgage? We don't want you to be handcuffed your entire time. Now, the interesting thing about mortgages, usually we write this on the board, we do a little graph and everything else, but because of the nature of what we're doing here, we can't. Now, the first question is, how long would it take to pay half the balance on a 25-year mortgage? So Practically speaking, what that means is from the time that you start your mortgage, $500,000, more or less, at what point in the 25-year cycle does it reach 250? Now, the most common answer we hear is 12 and a half years, because you'd think half of the payments are done halfway through 25 years, but it's not the case. It's actually 18 years. And the reason why is because the interest is all front loaded. So the last 7 years, you'd pay the additional, all of the $250,000, you pay that off, but it takes 18 years to reach the halfway point. Now, if you even added $100 extra beyond your regular payments, you could knock almost 4 years off of a mortgage. So the extreme example is if you doubled your payment. So let's say your payment is $2,500 a month. What would happen if you increase that to $5,000 a month? How quickly do you think the mortgage would be paid off? Obviously, it wouldn't be 12 and a half years, it'd be less than that. And the answer is just over 6 years if you doubled your payments. So that's really exciting. I had one client that did it. And the funny thing was, as soon as he did it, he went and bought a bigger house and started all over. But he actually paid off his house in 6.5 years. Okay, so let's talk about some different payment options that exist in the marketplace. You've got probably the most common example of mortgage payments would be a monthly payment. But there's also things like bi-weekly. If you think about bi-weekly, you've got 52 weeks in a year. So bi-weekly is 26 payments. And bi-monthly would be not as quick. It would be 24 payments. And so bi-weekly, you're actually making a bigger dent in the mortgage, accelerated. So they're going to look at a lot of these are really kind of just chunking away at the mortgage, making 13 payments instead of 12, those kind of things. So there's lots of options that exist out there. I would say if you're right at the top of your affordability, probably not a good idea to take those up. Now, free government money is the next thing I want to talk about. Obviously, Scrooge McDuck, one of our favorites around here at the Charlton Advantage. He's a great character. Remember DuckTales? Okay, so the first-time home buyers RSP withdrawal plan. Now, you receive a massive benefit for being a first-time buyer. We already talked about the land transfer tax rebate, but there's also this. So it allows you to withdraw up to, it's actually $35,000 per person from your RSP, and that's gone up. It used to be 20, then it's 25, 35. So if you had a couple, you could actually get $70,000 of money from your RSP that you can withdraw. If there is $70,000 there, tax-free. It's the only time in your life you can take money out of RSPs tax-free. Now, typically what happens is you pay that off after it's done. The year after it's done, you pay it off in 1/15 segments, put money back into the RSPs. If you don't, you're penalized as it's going to be income. But the point is there's some interesting ways that you can use this program to really help boost your down payment. Now, the 3 ways that this typically works, number 1 is you already have money in the RSP. Okay, so that means that you've contributed in a previous year. You can just take it out and use it, and you would have received the tax refund in a previous year. So what happens when you contribute to an RSP is you would be paying taxes every paycheck. There's deductions. And so you would have actually overpaid on some of those deductions, and the government writes you a refund check because your RSP essentially brings down your taxable income. If you contributed $20,000 in 1 year to your RSP, and let's say you're making $100,000 a year, you would actually report that really as the net, is you'd say, I actually made 80 because I put the extra $20,000 in the RSP. Okay, so that's how that works, but you were taxed on the $100,000 income when you should have been taxed on the 80. That's how refunds work. Okay, so option 2 is you can put your money into your RSP this year. Okay, so do it today, and then you claim your tax refund in the upcoming tax year. So usually the deadline for RSPs is the end of February. So if you happen to be watching this video in January or February, if you put it in before the deadline, then you can actually get your money in the spring. Now, if you're watching this between February and December, you would claim your refund the next year. So probably the spring of the following year would be when you get your refund. Okay, so that's basically how that works, is that you can, in order to claim your money out of your RSPs, you would basically have to leave it in for 90 days, and then you can take it out to use it towards your down payment. Actually, it doesn't even need to be your down payment. Most people think, okay, it's got to be housing related, but it actually doesn't. You can take the money out, and by you being a first-time buyer, you can use it for whatever you want. But the smart thing to do would be to use it for the house. But if you want to buy a new stereo, you could. Anyway, so the tax refund would actually happen on essentially the next tax reporting year after you put it in. Now, here's the fun way of doing it that nobody really thinks about, and it's perfectly legal. But you could actually take an RSP loan, or you could borrow the money from mom and dad. Say, hey, look, I need $35,000. Maybe your spouse does too. They ask their parents. You guys each put in $35,000. Leave it in for those 90 days. And then on day 91, take it out, pay it back. So you may have gained a bit of money as far as interest while it was being invested in the RSPs. And that might offset the interest that you have for your RSP loan. But the point is that you've created a balance in the RSPs. So now you're going to get your rebate in the spring that you can use in addition to taking all of that money up front. And if you have to give it back, that's fine. That's a zero balance. That didn't, did mom and dad get their money back? But you've created money without using any of your own money, which is kind of interesting. So the tax refund has been created. That's the benefit of doing option 3, is that not touching any of your money, or even not even having a balance in the RSPs, you could still manage to create the money that you need for your upfront, which is oftentimes the hardest part of buying a home, from doing it this way. Okay, so pretty exciting stuff. It may be a little bit confusing. If it is, you can reach out to us, ask some questions. Make sure you have the contribution room. So before you put some money in the RSPs, you want to check your notice of assessment to see if there's actually room in there to do what you want to do. We talked about this, needs to stay in the RSP for 90 days. You have 15 years to pay it back. If you don't pay, it's added to your income. So first-time buyers, or 5 years of no ownership, and you want to speak to a professional. This is one of those programs where the more income you have means the more tax you pay. It means the bigger the rebate. So it's one of those things where this is a rare occasion where the more you make, the better this works for you. And somebody who has, maybe just part-time work or low income, this is not a good idea to use this, because the rebate and the refund is not going to be significant enough to really make a huge difference. Okay, good. So I know that's, like I said, it's a little confusing. Some people kind of go, really, how does that work? Bottom line, you can use RSPs to buy a home. If you're a first-time buyer, you can take money out, and you can also use some creative ways to get a refund, either using your money or sometimes not using your money and using someone else's money. Okay, so let's talk about the pre-approval. Now, this is an important step in the process. And so why would you get pre-approved? So you can save money with a rate hold. So once you get approved in writing, your rate is going to be held, and it might be held for 90 or 120 days. I think the longest I've ever seen is 180 days it's been held. And then if interest rates go up, then you're going to get your lower rate. And if interest rates go down, you're going to get the lower rate there too. But you're locking yourself in, so you're never going to pay more than the interest rate on the rate hold. Now, there might be conditions to be met before buying, because you might think things are good, but meanwhile, somebody with the same name as you hasn't been paying their 407 bill. And by the way, this does happen quite a lot, and it's tanked your credit. Or that dispute you've had with Rogers over your cell phone, they've put a thing in collections and now your credit's shot and you had no idea because every other bill you've ever paid has been on time, things like that. So you want to know that up front before you buy a home and then go, oh my, look at the problems I've had. Or I do have. Faster turnaround. So in a competitive environment where there may be people eliminating conditions or reducing the days in order to look into their financing, you're going to be the buyer there saying, look, I looked into everything. I know I'm good. You can save time by shopping in the right price range, because once that comes down to the want versus can discussion of you've got a personal budget, you have a max budget the bank will give you. And some people are conservative. They'll actually go shopping for a range that, is probably less than what they could. There's nothing wrong with that. But if they really were going to look at, I'll give you a common thing that happens with our clients is sometimes they come to us and they say, look, I'm approved for 800,000. I don't want to spend more than 650. But what they're getting for 650 is a home they're probably going to have to move in a year or two. So what I say is, look, imagine yourself in the home for 5, 7, 10 years. If you could increase your price, let's say by $30,000 or $40,000, that's going to save you money because you're not going to have to sell the home, pay all the expenses to sell it, pay another round of land transfer tax, all those kind of bills that are going to show up on the sale and the buy of the next house. It's an equity erosion when you buy and sell often. It's hard to kind of get ahead. So it's better sometimes just to buy the home that's going to last longer, so you can save yourself those expenses. So the point is that you're shopping in the right price range. You know your max and you know your minimum, and you can decide where you fit in from there. Make sure it's in writing and make sure they ask for things like pay stubs, tax returns. That's how you know it's a real pre-approval, because some people think, oh yeah, I'm pre-approved because someone just asked them, how much money do you make? Okay, fine, buy for this much. That's not. We call that like a pre-qualification. The pre-approval is in writing and they would have asked you specifically for proof of documentation. That's how you know it's rock solid. Okay, so the lender's going to look at 4 things when they're giving you the approval. Okay, and this is from your side too. They're also going to look at the value of the house, but from your perspective, there's 4 things. Number 1 is income. Number 2 is down payment. Number 3 is debt servicing ratio. So your total debt is a percentage of your income. That includes student loans. It includes credit card minimum payments, lines of credit, those kind of things. And they also look at your credit score, which is a measurement of how well you repay debt. And so if you look at somebody that's new to Canada, their weak spot is credit. They don't have Canadian credit, even though they may land and have a job. They may have a really good down payment. And so self-employed would be another one where income is the tough one for self-employed because it can fluctuate and it's not a regular paycheck. So the bank usually, or the lender, whoever is funding the mortgage, they're going to look and say, okay, if you're weak on one, we got to have 3 other legs that are strong. There are some lenders that'll lend if you only have 2 legs, but what will happen oftentimes is your interest rate will go up because you are a much higher risk to that institution. So the risk is reflected in a higher interest rate and more profits for the lender. So we usually say there's usually 2 categories that people fall into. So A lending would be somebody that has credit at least in the high 600s, 700 or above is ideal. They've got a 5% or more down payment. They've got a total debt servicing ratio of 40%. So what that means is, in addition to the housing related cost of the mortgage, the heat, and the property taxes, that in addition to that, so that's called GDS, the total debt servicing would be another, essentially 8 to 12%, depending on how you qualify. So these sound complicated, but really your gross debt servicing, which is just your housing related expenses, mortgage, heat, taxes, that can't be more than 32%. So whatever you're making on your gross income, your house has to fit in at roughly a third of that. Okay, so if you make, $100,000 a year, your house related expenses, your GDS can't be more than probably 33,000, so 32,000. And then some banks will stretch it up to 39%. And then the total debt servicing is the extra above that, which is your other things, student loans, credit cards, those kind of things. Okay, so A lenders like steady income. They don't love having self-employed. B lending would be things like self-employed, new to Canada, damaged credit. There are lenders that will lend to those people. And sometimes the rates don't change, sometimes they do. And the thing is, A lending is usually pretty stable, but B's, you can kind of play the A game a little bit depending on some of your other qualification. It's good to speak to a mortgage professional about that. Okay, so this is what we were talking about with total debt servicing. So your mortgage, $2,000 a month plus your taxes and heat, $30,000. Let's say your Visa minimum payment is $500. Annualize that, it's $6,000. Your car lease is $500 times 12. That's another $6,000. So the total debt servicing for this individual would be $42,000. Now, if the household income is $105,000, my question to you is, would you lend to them? If this was your uncle or your brother, would you lend to them? Is this a situation? Remember, they still have to pay their income tax. They have to pay gas for their car. They could pay for the car. All those other, they have to put clothing on their backs. Does this make sense? Most lenders would say, yes, we would do that. It's a 40% TDS ratio. And if you remember from the previous slide, they would go potentially as high as 44% for the right candidate. But they would definitely approve that 40% ratio. So your credit report. There's two companies that will report on credit, Equifax and TransUnion. I think it's about $30 to request it instant access. It's free through the mail. It's your information, personal information, recent inquiries. The average Canadian score is 720, and 650 to 680 is considered the minimum for the A lending we just talked about. So how can you improve bad credit? Maxing your balance out every month is generally not a good idea. Some available space is good and a positive influence on your credit score. Length of time that you've had credit is important. Don't open new cards unnecessarily. Don't request credit too much. If you have too many hits, there's talk that can bring down your score. Pay your bills on time. Captain Obvious here, just the minimum payment, just get something in there to pay your bills and your credit will improve. There's a lot of coaches and a lot of the mortgage lenders will actually tell you, here's how you can improve your credit. And if you're disputing that Rogers bill, like I talked about, just pay the bill and fight it afterwards because it's ruining the credit, which can ruin your chance to buy a house. Now, we talked about the Canadian Mortgage and Housing Corporation. There's also Genworth and Canada Guarantee, but there's three companies that provide this high ratio mortgage insurance. And it's when your mortgage is more than 80% of the purchase price, which means you're putting less than 20% down payment, you are insuring the lender so that if you don't pay, then they're covered. So whose interest is it protecting? It is the lender's, not yours. But it allows you to get in and to put 5, 10, 15% down instead of 20 or 25% down payment. So it is a benefit to you. It lowers your barrier to entry, but in exchange, you got to write a check up front. You can see different premiums. These change all the time. But as you scale up, the premiums get smaller. So if you're going to do a 5% down, your purchase price can be $500,000. Your down payment's $25,000. That means your mortgage is $475,000. Your CMHC premium, let's just say it's 3.6%. That would be $17,100. There's an asterisk there because remember the PST on the insurance premium is paid as a closing cost. So the actual amount, if you rolled that $17,000 in, would be that your mortgage is $475, but the amount you're actually borrowing would be $492,100. So just like I said, that note there is that's a closing cost. Okay, so your actual payments would be a little bit higher. Now remember the rule of thumb that we talked about. It would be $50 for every 10,000. So we're $17,000 extra. So the payments would be probably about $80 higher with mortgage insurance compared to without. Now, there's also some stress tests in the market, and these have changed. They were originally brought out, I think, in about 2016, 2017. And what they really do with stress tests is they qualify you based on a higher rate. So even though your payments are based on the actual rate you're getting, they're going to inflate that by 1.5%, 2%, and they're going to see if you can still make your payments. Functionally and practically, what it does for you as a buyer is it lowers your max purchase price because they're going to create an artificial limit of payments that you can't go past. So even though you qualify for more, the stress test will lower your affordability. What it's actually done in the marketplace is it's put more pressure on the lower price range because it pushes everybody down a notch. And what we've seen happen is a lot of times buyers that kind of qualify on paper to buy a semi-detached, maybe they have to buy a townhouse because of the stress test. But the point is you can still buy a house. Now, insurance gets confusing when you're buying a home. There's all kinds of insurance that we talk about. And so the high ratio mortgage insurance is one of them. There's the creditor insurance. There's your building insurance. So let's talk about high ratio, protects the lender, and all the things that we mentioned there. Creditor insurance is really, it's what it's there for is that when you're offered a mortgage, whoever the lender is going to say, okay, we will pay your mortgage off if there's a loss of life, if there's disability, critical illness. It's added on to the mortgage payment. Maybe it's a $30, $40, $50 payment above and beyond your mortgage payments. And they agree to pay off the balance of the mortgage. The thing I'm not crazy about personally is it's underwritten after the incident. Okay, so they decide basically after something happens whether they're going to pay. Not really a big fan of that. And there's also a diminishing return over time. And so your mortgage balance gets lower and lower and lower. So if you die on year 20 versus year 1, you get less benefit on year 20 the longer you've been paying in. The less benefit you receive. I tend to be a bit more of a fan of like life insurance, term insurance, those kind of things, where the benefit remains the same regardless. So your building insurance, right? So it's fire, flood, theft. It's required to get a mortgage, okay? So if you are dealing with a lender for a mortgage, you have to get house insurance, building insurance on the actual structure. And then there's traditional insurance, like we said, life insurance, critical illness, disability. Check with your employer, but often it's inadequate. And my favorite quote about insurance is the biggest problem is that we either live too long or we die too soon. That's why we need insurance. Okay, so there's some other language that we hear out there. And the first one is amortization, which is just how long your total mortgage payments are based on. So usually that's 25 years. If you're putting more than 20% down, you can go up to 30 years. Term would be sliced pieces in the amortization. So you might stay with one lender for 3 years. Then you go to another lender for 5 years, and then you go for 6 months or a year, then you go back to 5 years. So the term is the section of that amortization that you've committed to a particular lender for. Now, variable and fixed rates are always an interesting discussion because there's times when one makes more sense than the other. Historically, variable rates, which float based on usually prime plus or minus a certain amount. Historically, there's never been a 5-year period where fixed has been more expensive than variable. So the thinking is if you're willing to weather some risk, you might actually save a few pennies by going variable. The problem is if those rates do start coming up, it can put a lot of pressure on you financially. So again, if you're stretched right to your limits, you may want to consider fixed payments where you agree for the term of the mortgage, this is how much I will be giving you every month, and it's not going to change. I'm not worried about if rates are going up or down. For me personally, I run a business. I have a lot of variable expenses in my business. I like knowing that my life is on fixed cost, but it can change with everybody. Everyone has a different philosophy and a belief and a tolerance for risk. Either one is going to be given to you in the sense that you qualify for it up front. The Canadian default rates on mortgages are very, very low. So you're buffered by that. But what's going to make you sleep at night more peacefully is usually what it comes down to. We don't see a lot of open mortgages, although by definition, variables are open mortgages. But open would be, well, let me talk about closed. So closed would be that you can only, make a certain amount of payments. Plus, there's things like prepayment privileges, lump sums, where, once every year you could put up to 15% of the balance of the mortgage towards, your principal. We talked about the $100 extra payment earlier. That would be an example of extra above and beyond. But you're closed. You're committed for that 5-year period. The best example I can use is if you won the lottery on the second year of your mortgage, you could pay off the mortgage in full, but you'd have to pay a penalty because you've committed for that 5 years. With an open mortgage, paying that off, there'd probably be a small discharge, but not as much as the closed because they know that it's open by nature. Rates are a little bit higher typically on open mortgages. And I would say for the fixed, there's not many fixed opens out there. Some people do it. I had a client who got paid in large lump sums and decided to go fixed open so that he could put as much as he wanted towards his mortgage without any kind of penalties or restrictions on how much he could actually put in. So good idea to speak to the mortgage professional about that. Buying with zero down is a bit of an interesting discussion. For purpose of this learning session, I would say you pretty much need to put 5% down payment in order to buy a home in Canada. There are some lenders that have some creative things to do with zero down, but always be careful when you enter into those arrangements because on some level, the 5% has to be there. There's also a new program. Actually, we're filming this in 2020. So there's shared equity. CMHC came out with one, but we're seeing a lot of other lenders where what they'll do is they'll make the barrier to entry less. So in this case, the government's going to match your 5%. You still need it. So that's going to help your payments if the government pitches in 5%. $500,000 purchase, they throw in $25,000. It's going to lower your payment. But what they are is they're now another shareholder in the increase or decrease of the property. Okay, so eventually you're going to have to pay it back either when you sell the home or after 25 years. And they qualify you lower, so you're 4 times your income. Right now, they're qualifying at about 5 times your income. And max household income of $120,000, which means your max purchase price is $480,000. That's a tough budget to work with in many cases, especially in Milton right now. But the point is that there's another company I really like in Toronto where they're saying, look, all you need is $25,000. We'll pitch in the rest. And then when the home sells, they're an equity partner, which means some of the profits are given to them on a proportionate share. I do like it. You just got to know what you're signing up for before you actually get too deep into it. And so there you go. I would say the last thing about mortgages, if you look at something like this, is what is the fine print? Is there a massive penalty? If you were to sell the house before 5 years is up, are you going to have a $40,000 penalty? What are the prepayment privileges? Can you pay anything above and beyond your regular payments? So it's not just about the mortgage. It's about how the mortgage is structured. Is it a collateral mortgage? Some of those terms I'll let you look up, but you want to know these kind of things. The rate is important, like we talked about earlier, but it's not the only thing. So we're going to take a rest, and that is the end of part 1. I hope you enjoyed it, all about your money, and that was part 1 of the buyer class. We'll be back with part 2 whenever you're ready.